now we have one of the most anticipated segments of today's event, which is panel discussion featuring some of the brightest minds in the quants world. This is where theory meets experience, and we dive into dynamic conversations on our first topic, which is how to incorporate fundamental factor quant versus quantamental, global trends versus Indian experience. But first, let me introduce our distinguished panelists. First one we have is Aparna Karnik. Aparna is a fund manager and also heads the quantitative investments function at DSP Asset Managers. She joined DSP Investment Managers in 2010 and has nearly 20 years of experience across quantitative investments, risk management, and credit research. She completed her master's in management studies from Jamnalal Institute of Management Studies. We welcome you. Next we have is Vineet Sachdeva. He is an entrepreneur, partner, quantitative equity, and systematic investing at Alpha Alternatives. He has over 25 years of experience in investing and fund management. His investing experience spans public markets, private equity, as well as special situations and structured finance. Vineet is an MBA from IIM Lucknow and graduated with honors economics from Delhi University. Welcome. Next we have is Mr. Rajesh Kothari. He is the founder and managing director of AlfAccurate Advisors AAA, one of India's most respected investment firms, managing INR 3,200 crores as of November 2024. With 29 years of experience in Indian capital markets, Rajesh has established AAA's radically resilient investment ethos and 3M philosophy, achieving consistent superior returns and winning many industry awards. Fourth one we have is Rishabh Nahar. He is an accomplished quant fund manager with over 8 years of experience in the equity markets. Since 2016, he has been managing funds with a data-driven approach, focusing on research and analytics alongside his team of quant professionals. Rishabh manages capital for prominent family offices in Mumbai, delivering consistent returns. His deep commitment to research and innovation drives his strategy for optimizing investment performance. Currently, Rishabh manages 250 plus crores in AUM. Welcome, all of you. To steer this conversation, we are delighted to have as our moderator, Bhautik Ambani. Bhautik Ambani is CEO of AlphaGrep, investment management, where he is responsible for driving business growth, strengthening and expanding the firm's domestic presence, and enhancing customer experience. Under his leadership, the company has launched AlphaGrep's maiden and industry-leading long, short, and long-only quant funds. He has over 18 plus years of experience in the AlphaGrep company. Prior to joining AlphaGrep, Bhautik was the executive director and founding member of Avendus Capital Public Markets Alternative Strategies LLP, where he was instrumental in growing the business to the largest onshore hedge fund in India. With this, we get started.
Hi, everyone. Good morning. I know this is the wake-up panel that we are starting with. Hopefully, everybody's got their coffee. Thanks, Rishi and Pankaj. I think this participation is amazing. We did the first event, I think, a couple of months back in a much smaller room. That was also full, but that room was much smaller than where we are today. So this is very, very impressive. So what we're going to do is, we have a very, very interesting panel here and a very interesting topic. So the topic is fundamental quant investing versus quantamental. We're looking at what's happening globally versus how it has shaped up in India. I'm sure most of us realize and recognize that we are still in very, very early days with regards to quant investing in India. But we made some strides in the last few years, but a very, very long way to go. I was just looking at some data, over the last few weeks or months, especially around quant investing in the US. And one of the things that I read was that now there is more money in the US, and everybody talks about US because US is 70% of the world market cap, right? So that is what matters today. There is more money which is getting managed by quant or under quant investments in the US compared to what humans manage. That number is broadly around 35% in the US versus what is getting managed by humans is around 24%. Obviously, that 35% includes index funds, ETFs, smart beta products. So it's just not only factor-based investing, but a lot of other passive investing which has taken into prominence. So I think that is where the world has changed, especially in the Western world. In India, again, we've seen passive investing go up in a drastic way. From passives, we have seen a bunch of smart beta products, single factor-based products, also take into prominence. So when I meet a lot of investors, family offices, I'm surprised with the number of investors talking about, momentum-based funds, low-vol funds, and the kind of AUMs that some of these funds are managing today. From that, we have also come to some simple multi-factor-based products, which again, when I see a lot of mutual funds, AIFs, PMS, which have launched some of these products, which is again gaining prominence. Some of us in the panel also manage something which is a combination of quant and fundamental, which is quantamental investing. So this is interesting on where we have gotten to in the Indian markets today. So with that, let me start this discussion here. We have a couple of people here. So Aparna and we have a couple of people out here who are more fundamental background and have started getting into more quant. Rajesh and Aparna. At the same time, we have Vineet and Rishabh who come from a more quant background, and then they have expanded to pure systematic investing. So let's see how some of this discussion goes. So I think let me start with Aparna here. Aparna, how has the journey been so far? You come from a more more fundamental background, even as a house, and then I think you all were one of the first ones to launch a quant fund in the mutual fund space in India. So how's been the journey so far? What is your experience and any learnings that you've seen so far?
So we started about 5 years back, and we started with a simple multi-factor strategy with more of a quality sort of a orientation or a quality style tilt, so to speak. And we had, of course, applied, more fundamental metrics in terms of how to define quality and how to define some of the factors. We had gone through the entire back testing and everything in the, using all the correct methods. What our learnings were, one is that while history, it repeats, it doesn't repeat, it rhymes essentially. And we also realized that, there are long periods of factor cycles. So even wanting to be, having a back-tested, approach, it could still mean that you may underperform the benchmark for long periods of time. And so, like, we also what we also realized was, we wanted to be super fundamental. Like, so we purposely didn't incorporate any technical or momentum factors in our strategy. But then later on, we came to as we evolved, we realized the benefits of having some technical indicators. So over time, how we evolved is we blended some of the, the fundamental with the technical. Initially, we started with a very low rebalancing frequency. As we moved forward, we increased the rebalancing frequencies from semi-annual to quarterly and now monthly, So the nature of the strategy sort of changed, and now it's much more quantamental than fundamental sort of strategy. We also, realize that, I think this is the fundamental part, that there are some factors which are important to fundamental analysts. The classic one is valuation, value as a factor. However, because it is very sector specific and very nuanced, it's different for how you look at it for some, like staples, consumer staples companies or, metals companies. So from a quant perspective, if you just apply the same metric across all the companies, the way it's normally applied for factors, it doesn't tend to give you a very good result when it comes to this particular factor. And so it gets a little bit ignored because people just dismiss it that, this does not matter as much because the backtests don't show it. But we know fundamentally it does matter because that's how we think as a fundamental analyst. Yeah. So then, and given the lack of data, so finally on one or two of these factors like valuation, we realized that even if the back tests are not showing us a very clear trend or a clear signal, but we chose to incorporate them into our strategy anyway. You know, so that is how we sort of blended some of these technical fundamental along the way to try and have a more consistent performance. I'll pass it on to.
Yeah, Rishabh, please, your experience.
So we started back in 2016, as a family office, and prior to that, I was working as a research analyst. So doing like traditional, going to the factory, meeting the management, and understanding the business maybe from the promoter side, and so the idea when we started back in 2016 was just grow family capital at in a robust manner. There was no target, there was no beating the benchmark kind of a thing, right? Now the problem that we were facing when we were doing fundamental analysis was that the subjectivity, the emotion involved, so many decisions to be made on a day-to-day basis. And back in 2016, I mean, Quant was pretty new, right? So I learned how to code with my partner, and we started running like simple backtests, like even single factor models were doing like 25-30% kind of returns, and those are surprising. So that's how we started. And so today we've come to like multiple like multi-factor models, and even moving to the quantamental space, because what we've realized is that data doesn't capture absolutely everything. That day Rajesh was also on the call, and he was pretty much on the fundamental side, and I'm with him on that side. So there are certain businesses that would not show up in a quant model, right? Like for example, if someone's done some capex, spent like 500 crores, it doesn't show up on the P&L or on the balance sheet. So, would not be captured and would require a human lens as of today at least, right? And as data evolves, we'll see how that moves. So, today we're running both a, multi-factor or a single factor model as well as a quantamental approach. And yeah, I think.
Thanks, Rishabh. Yeah. So for me, it's a very different evolution. So earlier, I also come from a very fundamental kind of, the first half of my career was pretty much into very, very fundamental. So I spent the first, I think, decade in private equity, where you get into the deep depth of the company, make changes and do all of that stuff. And then about 10 years back when I was at D. Shaw, that was the time when I was like looking at the public markets, and we used to do a lot of public markets, including quant investing. But my heart was still in fundamental or, investing in companies and see capital appreciation rather than, the pure quant approach that you have. And one of the things that we figured out at that point in time is that, we keep talking about the greats of investing, right? You talk about Warren Buffett, you talk about George Soros. The important thing that most of the people don't realize is the kind of makeup that they have, right? So they have strong convictions. They do not let sentiment come in the way, which for normal mortals like us always comes in the way. You buy too cheap, you sell too early, you sell, you regret, all that stuff. And we did a lot of work, and we realized that one way to, probably harness some of the things that some of these greats have achieved is by following a systematic approach. So when we started out, again, it was pretty much for prop capital and a couple of large investors who said we will grow the capital at rates, and unconstrained by anything. So again, the core at that time was quality itself, right? Because again, Indian markets, quality had always performed. So we were kind of quality and value focused. In the beginning, it was, even data was not available. So if you want to run a quant strategy, you at least have to have a certain market cap. When we started out, I think the 200 largest company had a market cap of $1 billion. Today, the 600 largest. So there was not that much of data, but we said, okay, we will look at some of these core tenets, which is quality, value, and evolve. So as we evolved in the prop and, a few large managed accounts, then 2018-19, we realized that momentum is becoming an important factor. So again, the question was, do we use only fundamental, or because momentum is pretty much price based? You can do a fundamental overlay, but then we said, okay, maybe try to see how you can put momentum. And as we've gone along, we've added sentiment, we've added a few other things, and now the core is still for us is that if I was to look at it, it is, I would say 70 to 80% of the base of the models that we've developed, core is fundamental. The execution and expression, I think quant helps you do that better. By execution, I mean like relative value, right? So a company in FMCG and a company in metals may have the same quality, but how do you see the relative value? Where do they stand? The relative quality. So that is one very important aspect that Quant helps you in. The second is risk mitigation, primarily through diversification. So I think Quant helps you in helping in constructing a portfolio which is not very correlated, and you can have different sources of alpha. So I think Quant helps you in expressing and building some of those fundamental factors that you have worked with or developed or that work in India. Thanks.
Hi. Yeah. Hi. Good morning, guys. So thank you very much, first of all, for inviting me on this panel. I think, so I'm a hardcore fundamentalist, and I'm sure most of the analysts probably or any managers, 40 plus, if somebody sitting in the room, they must be hardcore fundamentals. And probably, as you see the age versus funda versus quant, more and more youth probably is moving towards more quant because they think more alpha can be made. But I think the most important thing, the centric, piece for any manager is how can we deliver superior risk-adjusted returns, correct? That's the core of it. Whatever we do, ultimately we need to deliver superior risk-adjusted returns. It means what? It means three things. One, we require alpha. Second, we need low beta. And third, most important, we need consistency of the alpha, which is called rolling returns. Now that's basically the objective. Any strategy, be it funda quant, be it quant funda, be it a fundamental, be it a mental funda, whatever you want to do, correct? Ultimately, you need to deliver this, am I right, for significantly long period of time. The fundamental part of it basically comes because we need to look at how our markets have evolved. So if you look at Indian markets, it's an entrepreneurial-driven economy, all right? Last 30, 40 years is an entrepreneurial-driven economy. It is a debt-averse economy. Bankers were never willing to fund the venture capital. For example, Infosys never got the loan, for example, am I right? So we are absolutely entrepreneur-driven economy. And in an entrepreneur-driven economy, therefore, it starts first with the management. Because irrespective of how good is your profit is, irrespective of how good your balance sheet is, irrespective of how good is your cash flow is, which all can be reflected under the quant, the important is whether the management is good or not, the ethics is good or not. And that's basically where we all start as a manager. Number one. Number two, the data is bedrock, undoubtedly. But the set of data which was available 1994 when I started my career to 2008 when it kind of a little bit evolved, and then as I speak with you 2024, is still evolving. Particularly in India, you don't see kind of data set what you can see in US. For example, we don't have the live radars who can tell us then how many godowns or how many warehouses of India's largest passenger car company has inventory as I speak with you. Even if I want to pay for that satellite, do I get that data? Answer is no. You can't get data, correct? It means I need to rely on the monthly volume. And if the Cement Manufacturer Association decides that they don't want to publish now monthly volume, sorry, I don't have any other data except the quarterly numbers to rely on. And therefore, the data is a bedrock. As the data keeps getting more and more in terms of the data sets, the complementary data which evolves, that's where it will help both funda guys or quant guys or combination to take the better. Ultimately, we all are trying to improve our decision-making process, how to make it faster. So that's number one. Second important thing is the exit strategy, because at our firm, what we clearly believe is the causality, be quality conscious in what we buy and be agile enough to get out of it. Now, what are the various tools which can help you to decide your exit strategy? So identification is one part of it, but exit is very important, second part of it. And here, again, what kind of a quant can help? So to be very frank, 3 years back, we run all different types of quants. Whatever you can think of in this world, we tried in our best possible way, Excel-based, not code-based, scientific guys, computer science guys, not based on that, pure Excel sheet. And the conclusion was very clear, nothing works. There was not a single variable which was working. Then we started doing A and B too. Then we started doing A, B and C. Then we started doing A, D. The conclusion was same. Nothing was working consistently. It was working for A point, then it was working for B point, then it was working for C point. But you cannot say that point A, the data set A, if you run based on that, kind of a semi-passive kind of thing, it can give you consistent alpha for more than 3+ years on a rolling basis. That was the conclusion. So we said, okay, let's stop here, all right? And again, make sure that how we can evolve the data. And to that, we started giving more of that. How do we make sure that we don't enter into the traps? So for example, forensic assessment. That can be more based on Quant, correct? Because forensic can be done only if you have a Quant. Because management, all management looks same. They all talk big, am I right? Everybody wants to be #1 company in the world. But life is not like that. So forensic assessment, the longevity assessment, those are the few important things where Quant can play a very important and critical role. Correct? And of course, your fundamental being, I mean, that's at least our first thing, is basically helps you to predict the earnings growth power, the pricing power of the company, the pricing power of the business model. To that, if you add the forensic assessment, the resilience assessment, the longevity assessment, your ability to take the decision that whether this company in which I would like to buy, can it give a long-term superior risk-adjusted returns? That basically your ability to take that decision goes up. So that's how we try to do that. So I believe ultimately, Quant is nothing but the data set, and that's what we've been breathing. Any analyst is breathing from a long time. So it is just not pure Quant, it's just not pure funda. It is a combination of everything ultimately which works.
Thanks. Let me try and just spice up this conversation a little. So as I can see on the panel, we have 75% of the people who were more fundamentalists have now got converted to Quant. Versus Rajesh, who is still more fundamental. I think as an industry also, we are seeing more and more people, moving from fundamental to some kind of systematic way of investing. Now, do you all think that, so let me start with Vineet here. Do you think that this is more like a fad because fundamentally most people are not able to generate alpha and hence now trying something new, saying that this is Quant, so let me now try systematic investing? Because fundamental investing has not worked, it's not helping me get alpha? Or do you think this is something which is going to be here to stay?
Quite a controversial question, especially after he's kind of trash talked us. So yeah, so I think the issue is not I think fundamental versus Quant. I think one of the issue here is that when you're doing, let's say you have the leeway or the ability like, let's say a Warren Buffett, right? Where you can hold and you believe and you can go to sleep, or you are running prop capital like you were, There is a lot more leeway, and there is a lot more leeway for you to be fundamentally oriented, right? But when you are, let's say, managing capital in fiduciary responsibility, and I'm saying not necessarily a big fund, also even if you're managing for 2 families, then obviously your other metrics come, right? So then you have to look at portfolio construction, you have to look at risk, you have to look at a lot of other things, right? And fortunately or unfortunately, as we are moving along, the capability of the human mind to process so much of data, right? So to process so much of data and put that into a box and say, okay, this is how this thing is expected to perform is becoming more and more difficult, right? And we're seeing this shift happen in the US. So in the US, it was active versus passive. So if you look at it, the first debate, last 15 years, right before, I think 2020, right? The big debate was active, passive, active, passive. But if you go beneath the surface today, you have the highest growth in the US is in smart beta. It's about 22% kind of growth. And you have all these small smart beta shops, which was like $500 million, grow to $60 billion. ARC is one of them, right? So the whole idea there is they are a mix of both fundamental and Quant. So what you're saying is that, yes, these are the fundamental tenets I have to follow. I have to buy a good company. Basically, what is investing? Good company at a reasonable price, which is expected to move up. You don't want a good company at a reasonable price, which is dead. So basically, quality, value, momentum, right? But the ability of Quant or data to be able to harness that becomes much easier than the human mind can process. So that is why I think as we go along, it's not this is dead or that is dead, but the trend, what is happening in the US, right, will happen. So if the fundamentalists don't learn Quant, they are dead. If the Quants do not take a lot of the fundamental inputs out there, they won't be dead. They may still survive, right? But the returns probably may not be as attractive. So I think going forward, you have to have a mix of the two.
Got it. So I think, Rishabh, maybe you can take a shot at this as well. I'm assuming you're, younger than 40, as per Rajesh. So you're still not a... yeah. Unlike all of us, definitely me. So I just want to check with you that obviously you also converted from being fundamentalist to now pure systematic. So what do you think? Has access to data gone up? The kind of information that you could access earlier to now, has that changed? Do you think removing emotions from your decision making, has that helped? And is it helping you perform better compared to what you could do earlier?
I think definitely, like, removing the emotion aspect of, like he said, right? Like the greats of the game can do it without having a structure. It's pretty much a mental framework. But for people like us, it's, we probably need a structure. We need a written rule book. I think one more thing I would like to add to this is that, so there are three things, right? Like, what do you want to buy, when do you want to buy it, and how much do you want to buy? I think most of the quant strategies or, most of the backtesting that you do, if you're doing a 30 plus stock portfolio, right, you can run a quant strategy and perform well. But the moment you want to increase position size, right, you want conviction, like you say, like a Warren Buffett has a 10 stock portfolio, it becomes harder and harder if you're not getting into the depths of the business, the management, what is the promoter looking at, right? So that distinction in terms of position sizing is where, somewhere like, I think that, a 30-40 stock portfolio, quant approach would hands down, do very well. But if you would move to a 10 stock portfolio, you have the risk of, and if you're not relying on any sort of subjectivity or meeting the management, then you can be very right or you can be, terribly wrong. So I think that distinction in terms of position sizing is, at least we've not come across models wherein you would say I can take a 20% position size just based on quantitative data.
Interesting, yeah. So you're saying basically diversifying away in a portfolio, especially with a quant portfolio, helps.
Yeah,
and
so
if
you're going to a 30-40 stock portfolio, then I think quant is an approach. But if you want to, generate like crazy alpha, right? If you want to, and that will come through larger positions, right? So if you want to have a 8, 10, 15% kind of position size in your portfolio today, probably data is a problem, or there isn't, there aren't any models that are, that can give you that kind of conviction that, okay, I can, just solely rely on the data and make this.
I'll come to that conclusion later, whether, 30-40 stock does better than, fundamental investing at the end of the, conversation. But just to take your point around risk, Aparna, how do you think risk management will work for a quant portfolio? What's your experience so far? Do you see any different way that you manage risk in a quant strategy versus when you invest fundamentally, right?
Yeah, I think what Rishabh said was absolutely correct, and even I think the same way. So when we are having a multi-factor quant strategy, typically we will have more than 40 plus positions, because we are not trying to, essentially the quant is trying to identify a characteristic, and the point is you want to have that characteristic in your portfolio, you want to have that exposure aggregated across your portfolio, but you don't have, or you cannot control the idiosyncratic or the stock specific or the business specific risks. So we are actually very, like, we take the portfolio construction, like we use a lot of constraints, the constraints being position size, obviously, then liquidity. So like I said, initially we were having a much lower rebalancing, now faster. So, when you are doing that, the liquidity of the position becomes all the more important. So you have to have constraints around liquidity. So essentially we don't apply pure quant other than the large and mid cap space. Anything where it is small cap or illiquid, we don't apply a pure quant approach. Apart from that, to address things like tracking error, etc., where how much risk you're running versus the benchmark, because like whatever we may say, we're not going to be, we're not Warren Buffett, right? So we will be evaluated based on a more frequent approach. So we need to control how much the risk we take beyond like the benchmark. So we have constraints around tracking error. So again, our effort on the quant is not to shoot the daylights out of the park. So our objective is, to have reasonable low cost alpha in a consistent manner. So we have tracking error constraints, portfolio active weight constraints, how much you can go overweight the benchmark, total stock weight constraints, liquidity constraints. So we build a portfolio where optimization factors all these things into account. Another thing I realized is that we even look at correlations across stocks. So you may think you're buying 3 positions, but it's actually just 1 position, because the correlations on the stocks are like very high. So it's not well diversified. So these are the things that we incorporate when we manage the portfolio construction.
Interesting. And I think one of the points that she mentioned is large, mid versus, let's say, small caps, where, as per Aparna, within large cap, mid caps, let's say quant works better than what can happen, let's say, with small caps. I think, Rajesh, let me bring you in here. Do you think going forward with, what you hear from some of your colleagues, panelists here, what you hear from the market, do you think going forward within the large and mid space where, information asymmetry is not there, maybe the markets are a lot more efficient, things will move more in the quant direction, and in the fundamental, pure, discretionary world, within the small cap space where, let's say, access to data is not the same, and maybe kicking tires is a lot more important, it'll still be more with the discretionary fund managers. What's your view there?
No, I think most important thing is the understanding the business cycles. And I keep saying that it is not about the market cap, it is about the profit size of the company. To my view, for example, Infosys is a small cap, for example, because Infosys is not serving to the Indian clients. Infosys is serving to the global clients. So when we are assessing Infosys, we need to compare with Accenture of the world, provided Infosys also thinks like that, correct? If Infosys thinks I am a big cap, then it's a problem. Infosys has to think I am a small cap, because how much % market share there of the world addressable time, correct? But you are absolutely right. So data sets are going up. The ability of the data to help you to improve, and I keep saying that. Ultimately, every analyst, be it whatever we can say, finally we all are managers. One can put different jargons, fundamental, quantamental. Again, let's not get into it. Important is data analyzing is very important. That's what Quant is all about.
Right.
And more data sets availability. It basically helps you to improve your decision-making progress. In large cap also, there are many companies in India which doesn't do even quarterly conference calls. For example, there are many multinationals. They don't talk. There are many companies, they do quarterly conference calls, but they actually don't reveal anything. They are just doing calls, correct? So your ability to understand those business cycle and correlating that small cap company from a particular sector to the large cap company of the same sector, that basically helps you from the data set perspective, the quant perspective, that can be a trigger even for the mega cap. Sometimes even a small company, the micro cap company in a quant, can give you trigger for the mega cap company on which you might have zero information. Right? Yeah. So it's all about the linkage of the different sectors and how do you think internally as a team, and then assessing those data on a very regular basis. And you have a right set of data sets. Once you have the right data set, for example, let me give you one example. Like for example, if it's a capital goods company, and suppose there are top 2 companies, I'm not talking about EPC company, I'm talking about engineering companies, where R&D is a moat, where technology is a moat. I'm not talking about a road construction companies. If you have a transformer company, which might be a micro cap, and if you have the capacity and order book data set, which is a quant, correct? It's a funda or quant, whatever you want to put it, but you have a data. Can it trigger you for the what is happening at the larger level where companies actually not talking? But the ancillary company, if this mega cap wants to be successful, they need to give order to that ancillary company which is in the value chain of $1 billion over next 5 years. Then only they can supply that equipment. Now that trigger can come from microcap. So you need to assess data very scientifically, and as more of data gets available, which is not yet available in India, it is still evolving. We are very early stage of the data dissemination. In fact, if you check with Bloomberg, and we always complain to Bloomberg that whatever data we get from Bloomberg.
Bloomberg is here, you can complain if you want.
Yeah, great. Yeah, and I think she's also aware about it. And they keep saying, sir, wo US mein aisa filter chalta hai, India mein nahi chalta hai. Because in India, the exchange's annual report comes in a PDF format. So there is no even common lines to compare. The revenue line of 2 Indian companies can be completely different assumption. And then you have a pre-Ind AS, post-Ind AS. Then presentation has some different numbers. So no data are comparable, unlike US, where the data is very fast and it comes in a very standardized format for someone to upload that data.
I think you complained about Bloomberg. Can't work. Okay, hopefully this is just a drill, so we'll continue here. I think one of the things that, we come across as a question, especially when we talk about systematic strategies, is how do you incorporate macro factors? right? Because when you are running a quant model around picking stocks, I'm sure it's very difficult to put in macro factors like interest rates, what's happening to interest rates, what's happening to crude oil prices, what's happening in geopolitical situation. It's very difficult to incorporate some of these things in case of a model. And I'm sure that's something where a discretionary fund manager can immediately take some of these decisions, spot some of these trends, which are very difficult. And, that I'm sure is a challenge for anybody who's running a systematic strategy. So, any one of you all who want to go first on this, how do you all incorporate this in case of a systematic strategy? And if you can't, then how do you overcome the challenge?
So what we do is keep it very simple. We don't buy oil and gas companies, we don't buy metal companies, and we prefer to buy debt-free companies. So that if the interest rate goes up, our companies are the most beneficiary. They are under leverage, correct? Yes. If the interest rate goes down, then anyway it doesn't make any difference to us, am I right? Yeah. So best is don't be in the basket which you can't predict. Because momentum factor, the weather, for example, crude oil, you put the macro factor crude oil. Now, can you tell me on what factor basis you can assume crude oil price will go up or go down? Because tomorrow there can be geopolitical tension. So we really clearly understand what are our constraints and play with your strengths. That's what we do it.
Got it. Yeah.
I think here I also have, so basically the problem with this is the holy grail of quant investing, right? Because factor timing, so to speak, So we have tried many ways, but at this point of time, we don't really apply factor timing strategies in a systematic way because I haven't seen any evidence that it's working well. One is the data comes with a lag. Any kind of macro data is lagged. Even if you're taking high frequency data also, it has already happened by the time you're catching it and you cannot react. And the market is always forward looking. And secondly, there's this interesting book or series called Three Body Problem. So essentially when there are multiple bodies, you cannot predict the interaction effects of those bodies, and you don't know which body is going to play an effect. So I know that even Druckenmiller had said very recently that just follow liquidity, you don't need to follow the macro. So there's so many variables when it comes to macro, and most of them only after they have already happened. So predicting them is really, sometimes you may feel a foolish exercise. Of course, you can capture patterns and trends through momentum, etc. But to do factor timing or macro timing is essentially a very, very, example of COVID, right? Everything was in doldrums, right? There was just absolutely, economies were shut globally, but the equity markets were rallying like crazy just simply because of liquidity. So different regulator, fiscal, interest rates, or everything has different role to play at different points in time. So we have we don't try to do too much of macro timing. I think we still need to see evidence.
What do you think? Does it even matter that you need to directly incorporate macro in investing, or indirectly momentum or some of these other factors will take care of it?
So there are two parts to the question. So one is that macro incorporate. So most of the quants today, if you look at fundamental quants, right, not the price base, you look at only past data. You mostly work on past data because you say, okay, somebody has achieved X, Y, Z, and most of us like to believe that most of the projections are always wrong, right? So in the past data, if you look at most of the macroeconomic factors and other factors are already more or less baked into the prices. So we don't try, so we have a model which we work on it. But if I was to look at the crystal ball and say that can we figure it out, and I think there is a lot of work going on in the US, especially with some of the large funds. This is where I think quant, or you can say now the newly emerging technologies like AI, ML, quantum computing will probably start getting an edge, because that probably model has the ability to connect some of those data points and kind of not predict, but give a more reliable path than what we have been used to, so far. Having said that, at this stage, it's already incorporated in the model, so we don't try to second guess.
Understood. Rishabh, you want to take a this?
So I think, you mentioned the momentum part, right? So I think definitely the macroeconomic factors play a role in, the interest rates, liquidity, like 2008, 2020, right? The rally that you just mentioned, it's pretty much a liquidity-driven rally. And though we don't incorporate that, But the idea with, like with incorporating something like that would be from a risk management perspective that, if the markets are down 40-50%, you don't want to lose, right? And therein momentum, plays a very important role, and not exiting your stock portfolio but adding derivatives, as a hedging mechanism could, could really help. But yeah, like, incorporating multiple macro factors would be really hard. The easier way to do something like that would just be, like following liquidity.
Interesting. So let me bring up another, maybe, I don't know if it's controversial or not, but a difference that we see between, let's say, a pure fundamental investing versus what we see in the quant world is churning of portfolios, right? The typical, background that we see around fundamental investing is buy and hold. You buy stocks, hold them for the long term because you're looking at visibility of earnings from a longer term perspective. And usually the holding periods are maybe a few years, right? Until something changes in between. So Rajesh, let me start with you. So obviously in the fundamental world, that is what we hear, saying that buy and hold works. Most people come from that background of Warren Buffett, Charlie Munger. That's the way they run portfolios. Versus what we see in the quant world is, obviously the churn is a lot more, portfolios change much faster. So one versus the other, what's your view there?
So our view is very clear. Sir, as I'm saying, ultimately what we are doing, deliver superior risk-adjusted returns. The business cycles are getting shorter. Thanks to the crude oil volatility, thanks to commodity volatility, thanks to currency volatility, thanks to geopolitical tariffs volatility. These four factors are making world VUCA, the volatility, uncertainty, complexity and ambiguity. As that happens more and more, and thanks to the momentum related factors adds to it, the earning swings of company is now increasing compared to what it used to be 10 years back. And because the markets, the way in which we are, globally as well as in India from the retail perspective, the wilder swings in equity markets are 3 times more than the earning swings. Let me give one example. On 6 March 2020, COVID was entering India. So generally we don't take cash calls. We are long only PMS guys. But on that day, our philosophy is protect capital, create wealth. So we sold 15% of the portfolio. And we said, which companies will be less impacted? So we said, pharma will be the least impacted. And we'll make 11-12% compounding bana denge. And we take that call, the risk what we are taking. If we go wrong, of course we'll underperform because markets will go up. We bought pharma stocks 15% of the portfolio. We thought it will give us 12% compounding over 3 years. It went up 65% in 4 months. 65% in 4 months. We exited entire pharma. And we bought back Titan and Trent, which we sold on 6 March 2020. So we strongly believe that as a manager, you need to track the business cycle. If the cycles are getting shorter, you need to play accordingly because the valuations are assuming that these are going to sustain. On 18th February 2022, if you had bought any IT stock in India, including India's largest IT company, stock went down 38% because of Russia-Ukraine war.
Yeah.
So we exited on that day because we said this growth and this valuation both are not going to sustain. The cycles are getting compressed. But Street is giving that EPS, that PE, IT stocks and chemical stocks became like Nestle's of the world. They became ATP. Because they thought the growth will be like Nestle every year compounding. But it is not going to be. Correct? Yeah. So, irrespective whether you are, whatever strategy you want to follow, we strongly believe in agility. And that's our strength. So, our churn is generally, about 35-40%. Correct? And we believe that cycles are getting compressed and therefore you need to do more of it over a period of time. And if the cycles again becomes longer cycle, fine, then, you continue to hold. No problem. But if the valuations are factoring today what you expect 10 years down the line, which has happened in the many platform companies, if you remember 2 years back when they got listed, and then what happened? 75% crash. Yeah. But then you need to exit at that point of time.
Yeah.
So that's what we do.
Yeah. Vineet, you want to take on this? 30% churn versus 300% churn for maybe a quant strategy. What's your view on that?
When we started out, as I said, we were predominantly quality value, and then we suddenly realized that there is momentum, right? So from an annual rebalance, in some models we moved to 6 monthly, in some models we moved to quarterly rebalance, because in addition to the 4 factors he mentioned, I think the other important factor is technology, how things are changing across the world, right? And some of these companies are dependent on technology. So I think as we are going with the evolution of technology, the cycles are shortening, the attention spans are shortening, how market values things are shortening. So I don't think that long-term buy and hold, unless and until you are one of those people who have the, who have the, let's say, the luxury of holding them forever, right, is going to be possible. So like those cycles probably may not come back again. Having said that, then now 30, 40, so we are also right, roughly around that 40, 50% depending on the model. 40 versus 2, 300, I think there you have to evaluate what you're doing. Like if you're running a pure strategy like momentum, right, you cannot afford to have a 30, 40% churn because momentum is again based on market, sentiment, blah, blah, blah. If you're running sentiment, now I don't know anybody who's been able to successfully harness pure sentiment, but at some stage it will happen. But when you're running strategies based on momentum or sentiment, then that 300, because your objective is to, be on top of what the momentum or sentiment is there. But broadly what I feel is that the churn is going to go on increasing as we go along because the information is moving at a faster pace, technology is changing at a faster pace, brands which used to be the biggest moat, right? Now with things changing, brands are also, the shines of the world are just upending everything, right? So everything is changing at a faster pace, so you can't hold portfolios for a longer time as we used to.
Yeah, you're right. So, in fact, one of our teams in one of our models does incorporate some of these alternate data sources like sentiment, high-frequency indicators like derivatives information, ownership data, analyst estimates. So all of that gets incorporated in one of our teams does pretty successfully, and at least we've seen good results so far. So very clearly, some of those data sets have started being available in India, which was only the case, let's say, in the US, but obviously there's a long way to go. I think, while we have this discussion around managing money for people, one of the most important things here is how is the regulatory environment in India for, let's say, running a quant strategy. So let me start with Aparna here, considering, you work in a space which is probably the most regulated framework, right?
Yes.
Which is mutual fund. So how's your experience so far? Do you think the regulatory environment is suitable enough? Do you see any challenges? Are there any constraints in terms of running a quant versus a non-quant strategy?
So the first constraint, of course, the regulators have been very open to considering these sort of strategies. But some of the few issues, I'll mention. One is that in the mutual fund context, you can essentially, they categorize funds in certain baskets. So quant, they put it in thematic basket, and they insist that it should just be called quant. Whereas quant strategies can be just as, varied as any active strategy. You can have
so
sectoral,
you can have large cap,
you can have large cap,
mid cap, small cap, anything can be quant.
Factor, quality, you can have. So what happens is that because they get slotted in a wrong basket, then from the sales or the distribution of the scaling of the strategies, they are not able to assess the strategies in the correct way. So large cap quant strategy should be compared with large cap or index. So the categorization of the strategy, it becomes a challenge. So it's difficult for somebody to say, okay, you compare me with this basket of stocks, which could be partly or funds, which could be some active and some smart beta and some quant. So that part is, that basketing or bucketing is a bit of a, it creates misnomers and wrong comparisons and wrong expectations. So there, I don't know, I think if something can be done to improve that, we would definitely think it would be beneficial.
I'm sure our friend Pritesh can help.
Yeah, I'm sure. So that is one thing. The other thing is that globally, if you see, there's a lot of innovation which is possible, in the quant context. A lot of it involves, derivatives and leverage. So obviously, this is something we're not allowed to do, or the regulator is taking very baby steps towards allowing it, allowing it in a very constrained manner, because obviously they're worried about, investors facing very large losses, which is correct from a regulatory standpoint. So if that can be...
Do you think one of those steps is, what SEBI's potentially coming up, which is the new asset class,
the new asset class. So
with a slightly higher ticket size?
Absolutely. So that's a very positive step which they have taken, and it shows that their intent is to move in that direction, but just that they will do it gradually. They will not sort of open the floodgates, right away. But it's in the right direction. But I think these two are some of the, main challenges which we face.
Sure. Any,
Yeah,
you know, talk about, yeah, please. Go ahead.
So, I think like we spoke a lot about long only equities on the quant side, but if you would open up derivatives as a topic of discussion, the suit will be very, the discussion could be a lot longer, right? So from the regulatory standpoint, I think structure is very important, right? If you're running a PMS and AIF as against a mutual fund, a PMS AIF like we were earlier speaking, right? If you run a momentum, you're paying 20 plus surcharge in terms of taxes, which a mutual fund isn't paying. So just the structure difference is one thing. And I think the other thing is that in terms of the derivatives as a, so the regulator is pretty much on the right track, that they are informing people that it's, you're going to lose money if you're just trading F&O. Yeah. But the idea is that derivatives as a product was introduced from a, from a point of hedging. And if that is, inculcated, if even on the fundamental side, right? Like, so in 2020, there were a couple of days when our markets were on a lower circuit, right? 20% lower circuit, wherein the US was not on a lower circuit. And the reason for that is that those 2 days, the regulator changed the margin requirements from, like, say, if you're, 20% to 100%. So mutual funds and other fund houses who would want to protect the portfolio wouldn't have cash. And now the only option is to sell stock. So I think, if there's some tightening of rules there, and if the rules don't change that often.
Yeah, interesting. I think, let me just bring out the last topic, which we can't, leave the panel without, is AI/ML. And that's something, which has gained prominence over the last few years. And a lot of people are saying that ultimately at some point of time, machines will run strategies and funds, and maybe all of us might just become obsolete here. So any views, can AI take over, or machine learning can take over some of our jobs? Can they start managing strategies? Can machines do some of these things? We know investing is not pure science, so can AI even be incorporated into investing? Rajesh, you want to start with it? Then I'm sure everybody has a view here on that.
Undoubtedly, it's like, 30 years back, suppose somebody said, can computer do better job? Of course, and computer did better job, 100 times better. So I think with AI, the efficiency will improve significantly. It will probably go 100x or maybe 1000x compared to where are we today, am I right? Your ability to therefore taking decisions, again I'm coming to the same point, will improve drastically. Can they replace human beings? Depends what the human beings doing that time. Ultimately, human beings have to finally capitalize on that AI information. If we can do that, and I'm sure we will do that, am I right? Like for example, today whatever information is available on that, we are still delivering alpha. Right? This information is available to everyone. But then why somebody is underperforming and why somebody is outperforming? And globally, only 5% managers outperform. In India also on a long-term basis, only 5-7% will outperform. Everybody cannot outperform. Otherwise, Nifty will be equivalent to what everybody is doing. Correct? So, the information availability, whether it is AI or whether it is a whatever language which will come up over a period of time, we need to improve our ability to take the decision based on that AI. And depending, if we can do that successfully, and can we be a little bit ahead? So for example, I was in Bangalore, yesterday, and I was checking with a few guys, what are they doing on the investment management world for AI? And I think, if I'm not wrong, JP Morgan also came out with one very big paper on the role of AI in the investment management industry. So right now it is more on they are looking at the full circle. So it is more on the operation side, more on the compliance side. Slowly it is coming to the investment management side. But it's a very, very slow, the robos of identifying stocks. So I was discussing with my team that I want a day where if I enter 8:45 AM in the office, I directly get a flash. These are the companies you should buy based on this. This is the company you should sell based on this. And then we decide whether we should do it or not. Am I right? Yeah. So yes, if that day comes, probably we have to then work more harder and more smarter and produce more superior risk-adjusted returns.
Vineet, your views?
Yeah, so basically I'll break this AI and ML into two parts. So I think ML and technology or faster computing, I think will change. It will not take our jobs away, thankfully, because that helps you process data, which is what I said earlier. Like Quant helps you process large amounts of data and make sense for that. So I think there is no way out of ML, and pretty excited about it. AI, I'm a little circumspect right now, is because for AI to perform my job. You need, most of the AI is built around LLMs, pictures, which is in the public domain, and then it tries to build intelligence, but eventually you need to provide it with data, right? So I think that AI is still some way away, in revolutionizing what we do, but ML is something which I think is going to make things much more efficient going forward.
Nice, nice. Rishabh?
I think I'm on the same page with what Rajesh and Vineet said. So I think it's it's more of a tool, and also it's the kind of data set that you're using. So definitely, back in say 2016, if you're making an Excel model versus today, if you're using a Python script, like say if Rajesh said that he did some back testing using an Excel sheet, but that same thing could be done using a Python script, using a machine learning model. And it could be done probably in 5 minutes, in 10 minutes. So time saving. Also the depth of the analysis could be a lot more. And I think this will keep evolving, but there needs to be someone who's taking that call, right? Like what kind of data do you want to feed? How do you want to clean the data? So this will evolve, but I'm not sure if you'll be fully replaced.
No, so I think all these new tools like, there was a calculator, then there's a computer. It just makes... it's like a co-pilot, the way Microsoft calls it, it just makes you hope that's the hope, from a human to a superhuman, it just enables you, it can empower you, it can widen your scope and scale. Like as a human analyst, they cannot cover, more than say 30 companies, but using a good data set, data is a huge advantage, but data can be a huge advantage. It can, make your coverage go even beyond the Indian data set to global companies or, other things. You can find patterns more quickly. You can, it removes your blind spot. So it can empower you significantly. It can help I guess it could help teams to become more efficient. Like the old teams where for each, you had 50 analysts. You may not need 50 sector analysts anymore, Maybe you could work with 10 or 15. So it would definitely go towards that path. But I personally, given the nature of investing, because it's not like a closed loop, like physics where equal to MC squared, So till the time it isn't like that, I think that role of the human and the judgment, and also market it's humans, right? It's human follies, it's human greed. So therefore the role of the human will always be there. But it can definitely be magnified and improved. So even the feedback loop in terms of, your decisions, which decisions worked well, it can help you to identify your own follies and your own, where you make mistakes more often. So there definitely it could be very powerful. So we should embrace it and, just help us get better.
Yeah. So I'll just add to, what rest of the panelists mentioned, and this is something that I learned from our team, which has started incorporating ML in, one of their models, so the pro is that it helps you get alphas, which are more non-intuitive, because usually as a human, the alphas that we work on are more intuitive because that is what we're used to. And that is what is helping some of our team members to generate alphas, which are more non-intuitive in nature. At the same time, the scary part is that you may give it some data, and the alphas that you get, you may not be able to understand, the effect of it, right? So to a certain extent, it becomes like a black box. So one has to be careful about how somebody incorporates ML in case of investments. So that's at least the experience that we have so far. But the point is that we have started incorporating that in some of our models. That's definitely there. So thank you so much. I hope this discussion helped all of you all. I think the jury's still out, fundamental quant or quantamental.
It's not versus, fundamental plus quant. Never versus.
So I think, yes, as Rajesh is mentioning, I think all of us will exist along with machines. That is the fact. So thank you very much.
We have the Q&A as well.
Oh, are we taking questions?
Which is left.
Okay.
So. Any questions? Anyone?
Hi, my question to the panel is, what would be the predictive power of ML, machine learning, and AI in terms of, say, forecasting? You gave a quick example of the numbers. You gave a quick example of how, you will forecast the numbers for, say, a capital goods company. You see the order book, etc. How do you see predictive power of AI and ML helping you, and how acute you believe that forecast will be for fund managers to kind of, maybe forecast earnings? Because you said that the business cycles are shorter. Then how will these forecasts help you really?
Rajesh, the question may be to you. Yeah, because so it's about how one can forecast, how...
Especially in the context that you're mentioning that the business cycles are going shorter, how do you see that these forecasts really will be helpful?
Yeah, so we are still in that evolving phase, am I right? We have not yet got that kind of thing. So till the time it is not there, humans have to do it. So data, and those data is to be analyzed in a right way. Whether now AI can do that, then it's a fantastic job, correct? But forecasters generally go wrong, am I right? So if you look at, for example, 2020, and if you take the front page of Economist, the best magazine of the world, it is never said that COVID is the upcoming risk, am I right? So risk is something what we don't talk, correct? So I don't think even AI will able to do forecasting it, because on those forecasting, people will do different trades. And therefore, that forecasting will also go wrong, am I right? So no forecast goes right. It's all about how much near you are to the direction of that forecasted earnings power of the company. Ultimately, that's what a job of a manager is. And AI is going to be a tool for that. How much right or how much wrong it goes depends upon what kind of code you are building in that AI. Ultimately, because you are building that code, am I right? So how you want AI to take that, what I would say, accuracy of the forecast, it is in your hands in terms of how we are wiring the code. So it will, just like how today two analysts differ on EPS of one company, similarly the two AI for the same number will differ in terms of forecast, because you are building the different inputs for building that AI.
Yeah.
Please.
Hi, my name is Kalpesh Parekh. I am from Share India. I have a question for Aparna. Aparna, this categorization issue, what you mentioned, probably this quant-based funds are not categorized. I mean, all the funds which are launched are categorized under the category of quant category only,
Yes.
rather than large cap or mid cap. Do you think this recategorization of the same, if it is done, this can open up the flux of gate for the inflow towards this size? Because then you can show the performance. You can beat the benchmarks of, large caps or something like that. And the awareness level will also go up. Because once you categorize into just a quant category, the larger masses of people don't understand. And that flows of money is not, coming into this category.
Yeah, I completely agree with that point. I feel that, it will, it may not open like a floodgate of AUM coming in, but it will definitely improve it from where it is today, because then at least your comparison set is more accurate. Otherwise, people generally don't like black box strategies. They want to know what they're investing, obviously, and they should know. So I think it will definitely help. It will help scale it up.
Are we presenting our case to the regulator, explaining the same to him?
I don't believe they're looking into it right now, but this is something we will definitely advocate from our side.
Okay. Thank you.
So I just want to add one thing here. See, ultimately, I'm not sure if today the regulator is stopping you from running a large cap fund with just a quant approach versus a discretionary approach. Which I believe is still something that somebody can do, that you can launch a large cap fund, but manage it, using a quantitative or systematic method. So I don't think that is something that the regulator stops you from doing. And beyond the point, whether AUM comes to that category of product or not is ultimately going to be driven by performance. So as long as you have performance, whichever category it is in, and that is what we've seen, right? Like ultimately money gravitates towards funds where there is performance. So if there is performance and there is a quant product, whether it's large cap, mid cap or thematic, I think a lot of money will gravitate towards that particular product.
There's one more question here.
Hi, can each of you tell what is the best quant strategy that worked in your experience?
I would be sitting in Hawaii, not here.
No, I didn't get that question. Like when you say quant strategy,
Particular strategy that works, for example, analyzing a particular data point and taking a decision based on that.
so at least my take here is that I don't think there is one particular strategy which works. I think it's going to be a combination of things. If you ask any fund manager also, I don't think they're only looking at one particular way of investing. They're looking at a combination of things. As you heard Rajesh as well, right? You got to be agile and take decisions as and when, something crops up. Similarly, even in the quant world, I don't think it's only about taking decisions using one particular strategy, because a particular strategy, yes, over a long period of time may give you some alpha, but in the short term, as markets go through regimes, you will find different phases where a particular strategy does well, doesn't do well. Similarly, what you see, let's say even in the long-only world, right? Like you will certainly see certain times when you see value fund managers do well. Sometimes you see quality fund managers do well. Sometimes you see, momentum fund managers do well. So these are similar cycles that you see even in the quant world or in the discretionary world. So I don't think it's one size fits all. And if it was, then I'm sure it'll get, yeah.
So on a lighter note, I'll just give 3 names, right? And you have to figure out who you identify with the most, and that is the strategy you should follow. Jim Simons, George Soros, Warren Buffett. Totally different styles, so I think it also depends on your individual makeup, how much risk, what return, how do you think, and what do you believe.
Chirag this side, I have one question to the panel. As Rajesh, you mentioned, India is an entrepreneur market and we have to take call on the managers, smart promoters and all. As per the history, that suggests that it has helped in generating alpha and all across the cycle. So we have seen in past 1 year power sector and the ancillary has done well. So any way quant strategy help in identifying which sector will perform and where the activity is moving on and all? Any of you experience in your career so far?
Yeah, definitely. So all data sets, basically it indicates, for example, let me give one very easy example. Like look at the automobile industry, correct? So 4 months back, inventory was all-time high. Correct? When inventory was all-time high, the cycle was against you. And right now, for example, in month of December, inventory of one of the largest company is less than 10 days. It's a quant. It's a data. With whatever, as I'm saying, whatever jargon you want to put around it, ultimately it's a data set. The data you need to analyze. Now, what you need to predict is whether this will continue or not. That depends upon your ability to predict the earnings power for that particular company. Correct? So across sectors, for example, microfinance. When you knew that the lending to microfinance going up by NBFC significantly, the kind of the risk tolerance is going down. And as the risk tolerance goes down, the NPA goes up. And as the NPA goes up, the credit cost goes up. And that was a quant. It was already there in the data. Data set were already telling us loudly. 4 years back it was telling us. But sometimes it takes time for the companies to deliver the numbers in line with what you are expecting. And you have to wait for it. Am I right? So there are tons of data sets. There are tons of quant factors which indicates that what can go right or what can go wrong. On that then you need to put your fundamental, your IQ on it to ensure and to assess will it happen or will it not happen. And then you take the, what I would say, the best possible decision as on particular that moment.
Okay, coming up to one last question.
Good morning, everyone. So now that we all know we factor in a lot of factors in our backtest, Python has reached to everyone's offices nowadays. So it's very easy to run a optimization of, let's say, 20 to 30 factors, get the perfect measure of what factor should be included. So my question is, among all the factors, how do you decide between, how do you differentiate between correlation and causation? There could be many factors correlating to, let's say, EPS growth or returns that are factoring in. But that does not mean that is the cause that is, getting the returns out. So how do you differentiate between the two, that is correlation and causation?
I think that will depend on your ability to backtest and, like the way you're segregating data, looking at, in sample, out of sample. So like he rightly said, right, most models today or most funds are running are pretty much correlation driven, that this has worked in the past and, it will continue working. But coming down to causation, so if you want to run a robust model, I think causation is the key. I don't think there's, it's not a short or brief answer. So I guess it's a longer conversation. But causation is, I think it's a good point that he brought up. And causation is, I think what we should be looking for, because that'll, yeah.
I'll just add one more thing, like at least our approach has been, because there can be so many, like they call it factor zoo, right? Is to go for a factor when there is also economic rationale for that factor. So, whether it is human behavior, whether it is, you need to be rewarded for taking extra risk of, business cyclicality, or essentially you're getting a premium because of, your business is stronger. If there is a pattern which you observe, or a correlation which is also backed by something which fundamentally is a logical, or economically sound phenomenon, then that gives you more confidence to go for, to incorporate that into your model.
So just a follow-up, most of the factors are used to predict earnings or the returns based on the correlation. Are there any specific factors that you all must follow just to mitigate the risk or control the downsides? Because no one usually does that. Is there any factors included for there in general models?
I think some of these things may take longer. Maybe Rishabh can do a masterclass separately on this, but because this is a longer conversation, getting into what factors work, don't work, what kind of optimization can you do, a correlation. So, we can have a separate chat around this. And I don't think any one of them are going to give the secret sauce to you. So great. Thank you. Thank you so much.
Amazing. So with this, we wrap up our first session.